Japan's national diet just did something the US and Europe are still debating piecemeal. On July 15, 2026, the upper house passed an amendment that reclassifies Bitcoin, Ethereum, and roughly 105 crypto assets as financial instruments, the same legal framework that governs stocks and bonds. This isn't a tweak. It's a structural rewrite of how crypto works in the world's third-largest economy. The bill is called the Bill for Partial Amendment of the Financial Instruments and Exchange Act and the Payment Services Act. It passed the lower house on June 11, cleared the upper house on July 15, and targets fiscal 2027 for full effect. Here's what it actually does. 5 pillars. 1. FIEA reclassification. Crypto exits the old Payment Services Act and enters the securities perimeter. Bitcoin, Ether, XRP, and roughly 102 other tokens become specified cryptoassets, legally on par with stocks and bonds. 2. Flat 20% tax rate. Down from a maximum of 55%. That's not in this bill, it's in a separate 2026 tax reform outline targeting January 1, 2028. But the reclassification makes it possible. 3. Bitcoin ETF pathway. No ETF has been filed or approved. But the FIEA reclassification gives the FSA the legal hook to build an ETF approval framework. Japan Exchange Group is preparing infrastructure. First listings projected no earlier than 2027. 4. Insider trading rules. Applied to crypto for the first time. Covers anyone with material non-public information on issuers, exchange operators, and pending listings. 5. Tougher penalties. Maximum prison term for unregistered operators jumps from 3 years to 10. Maximum fine rises from 3 million yen to 10 million yen. The headline figure tells the story. Under the old rules, crypto gains were taxed as miscellaneous income, a progressive rate that could hit 55%. 45% national plus roughly 10% local inhabitant tax. That created genuine seller paralysis. If you had a large unrealized gain, the government claimed more than half. Nobody sells into that. Nobody buys more after realizing that. The reform aligns crypto with equities at a flat 20.315% to 15% national, 5% local, plus a small surcharge. Losses become carryable for up to 3 years. But here's the catch. The 20% rate only applies to specified cryptoassets traded on FSA-licensed domestic exchanges. Staking rewards, DeFi yields, NFTs, and trades on foreign or unregistered platforms stay taxed as miscellaneous income at up to 55%. That's a two-tier tax structure that financially penalizes any activity outside the surveillance perimeter. Finance Minister Satsuki Katayama framed it as expanding the supply of growth capital while ensuring market fairness, transparency, and investor protection. This is where the scale becomes clear. Japan holds approximately 2,000 trillion yen, over $13 trillion in household financial assets. That's the largest pool of domestic savings outside the United States. Even a 1% allocation toward crypto would represent roughly $130 billion. That approaches the total assets held across all U.S. Bitcoin spot ETFs combined. Bitcoin spot ETFs are expected on the Tokyo Stock Exchange between 2027 and 2028. Nomura and SBI are both positioning for spot crypto products. Their arrival opens crypto to pension funds, insurance companies, and corporate treasuries, entire capital categories that simply had no regulated gateway into crypto in Japan before this law. Koichi Kano, Japan head at QCP Group, said the legislation gives market participants long-awaited clarity. SBI's chief executive criticized the pace as extremely slow. 2 days before the Diet vote, on July 13, SBI Holdings, a $230 billion financial group, announced a strategic collaboration with the Solana Foundation. The venture is called SBI Solana Global. 5 target areas: JPYSC stablecoin distribution, tokenized real-world assets like corporate bonds and real estate, cross-border settlement infrastructure, on-chain financial services for institutional investors, and payment rails for the AI agent era. SBI already debuted the JPYSC yen stablecoin on Ethereum in June 2026 and activated Solana trading and custody services the same month. This is a group actively building a multi-stablecoin, multi-chain strategy, with Solana now anchoring the tokenized RWA and institutional settlement layers. The bullish case is straightforward. But the other side of the trade is sharp. The 20% rate only applies inside the licensed perimeter. Every holder who wants the lower rate is incentivized to move their Bitcoin onto a licensed, KYC reporting exchange. The MiCA playbook produced the same gravity in Europe. Regulatory compliance pressure, not an outright ban, is the mechanism that routes holders into the monitored system. The bill text does not address self-custody, DeFi, or staking. Those determinations are left entirely to FSA secondary rulemaking through 2026 and 2027. Until those rules publish, self-custody and peer-to-peer activity sit in a regulatory gray zone, not explicitly protected, not explicitly prohibited. Industry representatives warned during FSA working group meetings that roughly 90% of Japan's domestic exchanges already operate at a loss. That compliance burden consolidates the market toward megabank-affiliated operators who can absorb it. FSA's secondary rulemaking runs through 2026 and into 2027. That process will define the ETF approval criteria, the treatment of self-custody, and the enforcement posture toward non-custodial platforms. FIEA reclassification targets fiscal 2027. The 20% tax rate targets January 2028. The U.S. Senate crypto tax framework moving through Congress simultaneously means Japanese and American regulatory timelines are converging. Two of the largest pools of retail and institutional Bitcoin holders are building licensed frameworks at the same moment. The falsifiable version of the bullish thesis, if FSA's secondary rulemaking explicitly carves self-custody out of the FIEA registration requirement and applies the 10-year prison penalty narrowly to fraudulent operators rather than non-custodial software, the framework is net positive. Watch the secondary rulemaking, not the headline. Japan is no longer regulating crypto at arm's length. It is folding digital assets into the same prudential, tax, and consumer protection framework that governs stocks and banks. The direction is unambiguous. In 2026, the center of gravity for capital-ready crypto regulation is shifting east. If you found this breakdown valuable, subscribe. I cover crypto policy and market structure every week. Drop a comment. Is Japan's approach the right model, or does the compliance trap outweigh the tax cut?